I think that what we've got coming in the future is a massive government global pulling back of the gold. So my question is this really just about the tariffs on gold, or could this really be so much bigger than that, and it's a repatriation of the physical gold markets? Time's going to tell what it is. We're going to keep paying attention to it, but I think it should be pretty darn clear that there are things that are falling apart, and if we're dependent upon the consumer is one big one.
Gold's recent surge past $3,000 per ounce is not just a reflection of speculation, but a fundamental shift in global financial priorities. According to Lynette Zang, a well-known market analyst, the increasing demand for physical gold rather than paper derivatives suggests that major players are preparing for a period of financial instability. Historically, the U.S. gold market has been dominated by derivatives, meaning most investors hold paper claims rather than the metal itself. However, the recent surge in requests for physical delivery indicates a loss of confidence in the financial system, pushing large institutions toward tangible assets. This transition is critical because, in times of crisis, physical gold holds intrinsic value, whereas paper claims can be rendered worthless. One major indicator of this shift is the record-high inventory levels in the COMEX warehouse. While this might seem like a sign of stability, Zang notes that such spikes in gold inventories have historically preceded financial crises. The question is not just about rising reserves, but who is demanding them. Reports suggest that the Bank of England, which stores gold on behalf of various governments, has been shipping significant amounts of gold to the U.S., where it is then delivered to private parties. This pattern aligns with previous instances where gold was rapidly accumulated ahead of economic downturns. With global uncertainty rising, it appears that key financial players are securing gold as a safeguard against potential systemic failures. Another critical aspect is the ongoing trend of gold repatriation. Over the past decade, nations such as Germany, Turkey, and Hungary have pulled their gold reserves from foreign vaults, signaling a move toward greater financial independence. This shift highlights a growing distrust in international financial institutions, especially in light of escalating geopolitical tensions. If more countries follow suit, it could mark a turning point in global monetary policies, potentially reshaping the role of gold in international trade. Gold's value extends beyond its price. It serves as a stabilizing force in an increasingly volatile economic landscape. We present the clips of Lynette Zang's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Now, I looked at what the the Federal Reserve of Atlanta does their GDP now. GDP is gross domestic product. It's all the money that flows through the system. And while it's not an official forecast, it is viewed as a running estimate of real GDP growth based on available economic data. Let's take a look at this. Does that look good to you? Because that is a tremendous drop in gross domestic product, which has an impact on taxes, and therefore it impacts the state services as well as the federal government's income, which then foretells greater deficit spending, both at the state level and the federal level, let alone at the individual level. So even though we're being told that this pain will be short-lived, I don't think so. What do you think? Do you think this is going to be short-lived? Because who's going to absorb all of those people that lost their jobs? And at the meantime, U.S. gold stockpiles hit record, right? And they're always pointing to the tariffs, but maybe what we're really looking at is a repatriation. Because in this country, in the U.S., most of the gold is done in derivative form. That means it's just paper gold. It's not real. And you can look at the gold inventory in the COMEX warehouse, and they hit a record high. But could you please take a look at when this happened and it never got back to those other levels, and now it's even higher? Because the dangers are even more. So you have to ask the question, who is getting ready for what? Because there is some fat finger or big player here in the U.S. that is demanding physical delivery. And of course, we know, because we've talked about this, that a lot of that physical gold is coming from the Bank of England, among other places, but a huge player in the physical gold market. They're holding gold for a whole bunch of governments, and they're shipping that gold to the U.S., and then that gold is being delivered out to a private party. So I think that what we've got coming in the future is a massive government global pulling back of the gold. So my question is this really just about the tariffs on gold, or could this really be so much bigger than that, and it's a repatriation of the physical gold markets? Time's going to tell what it is. We're going to keep paying attention to it, but I think it should be pretty darn clear that there are things that are falling apart, and if we're dependent upon the consumer is one big one. What are you going to do when this whole system implodes? Because that's what's happening, and it will. And that's why you have to have physical gold and physical silver in your possession. And you need to have sound money as a foundation for whatever else you're attempting to do. Because a properly diversified portfolio, okay, it can have some intangibles. It can have some cryptocurrencies, some stocks, some bonds, some mutual funds, some ETFs. But you darn well better have the gold to balance that out, so that when the dollar goes to zero, and you might not even believe that it's going to zero. Look at the purchasing power chart, because the Federal Reserve is telling you that it's going to zero, and it's very close to that now. It's just that little layer of confidence. And if we're having to deal with higher inflation, what do you think that's going to do to the public's confidence in the currency and in those that are driving the economy? That's it. It's the last layer of confidence, and I see it going away.
The weakening purchasing power of fiat currencies has made gold an essential asset for wealth preservation. The Federal Reserve's monetary policies have led to a long-term decline in the dollar's value, a trend that is becoming more pronounced as inflation continues to erode consumer spending power. Zang warns that in such an environment, individuals and institutions must hold physical assets to protect their wealth. Unlike stocks or bonds, gold carries no counterparty risk, meaning its value does not depend on the stability of a financial institution or government policy. This is why many investors are choosing to allocate a significant portion of their portfolios to physical gold. For investors, this shift presents both a challenge and an opportunity. While the cost of gold has risen, its role as a hedge against economic turmoil makes it a crucial component of a diversified portfolio. Zang emphasizes the importance of balancing intangible assets, such as stocks, cryptocurrencies, and mutual funds, with tangible ones like gold and silver. As more financial institutions and central banks move toward gold-backed reserves, those who have secured their holdings early will be better positioned for future economic shifts. The historical precedent is clear. In times of uncertainty, gold not only retains its value but often appreciates significantly. Let's get back to the interview.
They have run a Fed paper that finds that tariffs may raise U.S. consumers' everyday costs. And we already know that the consumer is very, very stretched to the point of breaking. But while tariffs themselves may not spur long-lasting inflation, empirical studies suggest they trigger an immediate one-time upward shift in price levels that persists. So actually, I think they're contradicting themselves, because they're saying that it's not going to spur long-lasting inflation, and yet prices that go up and stay up, okay. So they just don't want you to realize the truth of it. While higher tariffs create tariff revenue and favor domestic producers, for a minute, the price consumers must pay to buy imported goods will increase, because firms typically pass some portion of the tariffs cost onto the consumers, or maybe even all of those tariff costs. Because we are a globalized system, the supply chains are all over the world. So even if we are a U.S. company, that means that chances are pretty good that something is going to be imported that's going to be impacted by the tariffs. So there's direct tariffs, and then there's indirect costs that they pass on to the consumers. And that means higher inflation. Now, you guys know I've been talking about the fact that I think we'll see much higher inflation to come about by June. It might happen sooner, it might happen later. I don't know. But either way, of course, there's going to be more inflation. There has to be. The U.S. consumer borrowing surges by $40.8 billion, the most on record. But let me show you what these credit cards loans owned and securitized. So what people are doing in order to maintain their standard of living, they're borrowing more money to do that. There comes a point where they won't be able to do that anymore. But you see that little securitized piece over here? What that means is that these are credit cards that have been repackaged into products and sold to you. Maybe they're sitting in your pension plan. Maybe they're sitting in your 401k or your IRA or any mutual fund or ETF that you have. But you are the one that's going to bear the brunt of it. And consumer sentiment is souring. It is going south. So yeah, huge amount of borrowing.
If the current trajectory continues, gold could easily surpass $3,500 per ounce within the next 12 to 18 months, driven by mounting economic instability, geopolitical tensions, and central banks' continued accumulation of physical reserves. Lynette Zang warns that as global debt reaches unsustainable levels and confidence in fiat currencies erodes, investors will increasingly turn to gold as a hedge against systemic collapse. Silver, often lagging behind gold, is poised for an explosive breakout as well. Historically, the gold-to-silver ratio has averaged around 50-1, yet it currently sits above 85-1, suggesting silver is significantly undervalued. If this ratio normalizes amid rising industrial and investment demand, silver could rally to $75 or higher within the next 2 years. As governments and financial institutions seek alternative stores of value, both gold and silver are likely to enter a prolonged bull market, reinforcing their roles as the ultimate hedges against inflation, currency devaluation, and economic uncertainty. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video.